Are you able to see this slide for assessment year now?
No, sir, it is still appearing the first slide.
Now?
No, sir.
No, sir.
No?
No, sir.
Just a minute. Now, assessment year. Can you
Yes,
see
sir.
the slide?
It is available.
Okay,
Yes, sir.
fine. Yeah, so good morning, everybody, and we'll continue with the discussion where we had left it in the last lecture. Last lecture, we concluded on the definition of assessment year, saying that it's a period of 12 months commencing on first day of April every year. And it's basically a frame of reference for certain aspects of taxation. Like whenever there is a change in the law, it is always specified with reference to a particular assessment year. Whenever tax rates are notified by the Finance Act or the budget, those are also with reference to a corresponding assessment year. And when you calculate tax liability or when you calculate your taxable income, you have to apply the provisions of corresponding assessment year. Now, apart from assessment year, which is a frame of reference, there is one more frame of reference called as previous year, and that we will discuss now in next section. Section 2, subsection 34, read with section 3. It says that previous year is a financial year immediately preceding the assessment year. So I was telling you in an earlier lecture that these two things actually go hand in hand. Your previous year and assessment year, these are two interrelated things. In what way are they interrelated? I will explain in the next few minutes. But basically, previous year is a financial year immediately preceding the assessment year. Now, if you look at our syllabus is going to deal with assessment year 2020-2021. So for this assessment year, the immediately preceding financial year is your previous year. So for us, the previous year will be 2019-2020. So for all of us, for our workings and problems and reference and syllabus, previous year is 2019-2020, which corresponds to assessment year 2020-21. Now, why these two things go hand in hand? Whenever you are trying to compute the income of a person, the question is which period's income you will take into account. And the answer is the income earned in the previous year. So whatever income you have made in previous year, whatever income you have earned in the previous year, that needs to be taxed. Now, when you refer to the income in the previous year, how will you compute that income? And then the question, provision says you have to refer to the relevant assessment year. So apply the provisions of given assessment year. And how to compute the tax liability? Again, apply the tax rates for given assessment year. So this is how the two things, that is previous year and assessment year, are interrelated. The income is earned in the previous year. While computing the taxable income of this kind, you have to refer to the provisions of assessment year, and even the tax rates for the corresponding assessment year will have to be applied. This is how these two things will go hand in hand. Okay. So this is the financial year immediately preceding the assessment year. So for our reference, our previous year is going to be 2019-20, and the assessment year is going to be 2020-2021. Now, though we are saying it is a financial year immediately preceding the assessment year, in all the cases, it may not be a full-fledged period of 12 months. So there are few exceptions where even a part of the year will be treated as previous. Somebody's mic is unmuted. Please mute your mic. किसका mic चालू है? Please. So most of the cases it will be full-fledged year, previous year, but in some cases it may be a part of previous year. So we are looking at some of the exceptions. For example, when you start a new business during the previous year, then your previous year will not be period of 12 months. It will commence on the date on which you start your business, and it will conclude on 31st March next. So for newly commenced business, The previous year will not have all 12 months. The previous year will have only part of the year, and that will be date of commencement of business. From the date of commencement of please mute yourself. Please mute your mics. Are you looking at the slide? Is it clear, visible now?
Yes, sir.
Yes, sir.
Okay.
Yes,
Okay.
sir.
So we were discussing about a fraction of the previous year. Whenever there is a commencement of new business, the previous year will be part of financial year. It will commence on the date when you start your new business activity, and it will conclude on 31st March next. Then the second exception is non-resident shipping companies. Now, what are these non-resident shipping companies? Their income related provisions are different. See, these non-resident shipping companies, they are the owners of ships, and these ships carry cargo across the uh, across different continents. So suppose they come to India carrying some inbound cargo. Now they will not be here for throughout the previous year. They will only visit a particular port. The cargo will be discharged. Fresh cargo may be loaded, and they will go back for the next voyage. So usually their income is computed on voyage to voyage basis under the provisions of section 172. So their previous year concept will not apply, but the voyage wise taxation applies to such non-resident shipping companies. That is one more exception to the previous year concept. Then, if a person is living India permanently or for a long period, somebody is leaving India going abroad either permanently or for a longer period of time, then even in his case, it will be fraction of the financial year that will be treated as a previous year. Then sometimes you have some special ventures for which you form an association of persons, or you may have an artificial juridical person formed for a specific purpose or event, and those entities are created only for the limited purpose of that activity or event. So again, their previous year will not be a full-fledged financial year. It will be limited to that period for which they are formed to carry out that activity or to conduct that event. So it will not be full-fledged year as such. Then income of a person trying to alienate his assets for tax evasion. If somebody is trying to avoid taxes and alienate his asset, that means dispose of his assets for tax evasion, then even for such person, special provisions will apply. And in that case, one need not go to the concept of previous year, but special provisions under section 175 will override and determine his income. And the last is income from discontinued business. Suppose you discontinue the business in the previous year. Then again, it will not be full-fledged previous year. It will be only part of the previous year. That is 1st April till the date on which you discontinued the business. That will be part of your previous year for all practical purposes. So though previous year means financial year immediately preceding the assessment year, these are the exceptions where previous year will be determined with a different reference, with a different time frame, and it will not be full year, it will be only a part of the year as such. These provisions are applicable only to these exceptional cases. Otherwise, all other cases, it will be full-fledged financial year that will be construed as the previous year. That's going to be the scenario across all the cases. And income earned in the previous year should be offered for tax. While offering it for tax, one should refer to the assessment year, the relevant provisions of assessment year, compute the income, then apply the tax rates applicable for that year, and find out the tax liability of a person. These are the things that one should keep in mind. Are you clear about these two concepts now? Previous year and the assessment year, which go hand in hand?
Yes, sir.
Okay, can we go to the next slide? Okay, assessment. We have not discussed this earlier, no? Assessment. Hello?
No,
No, sir, we are not discussed it.
Okay, okay. The slide is clear, na? Assessment section 2.8.
Yes, sir.
The
Yeah,
slide is
sir.
visible.
It's
Okay, 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 okay. Now we'll have a next definition, that is assessment. The shortest definition. You will be amazed to see that the definition has only 3 words. The definition says assessment includes reassessment. Only 3 words definition. Now it's a classic example of inclusive definition. What did I tell you about inclusive definition? Inclusive definition only tells you what is included in the definition. And many a times there are some words in the inclusive definition for which you have to go to its dictionary meaning, natural meaning, or the context in which the words are used, its general use in common parlance or public usage. Those are the parameters which will be applied for interpretation of such definitions. And assessment is one classic example of such kind of inclusive definition. It doesn't tell you what is assessment. It tells you that assessment includes reassessment. So then how will you understand assessment? Then you have to go by the natural meaning of the word assessment and the context in which it has been used. All of you have heard the word assessment, right? So what is your perception about the word assessment? What does it mean? Can someone share?
evaluating.
Evaluation, that's right. Okay. Then what is meant by assessment? Any more on assessment? Natural meaning of the word assessment?
Analyzing.
Analyzing, okay. When we
Interpreting
normal
the result.
interpretation of the results, okay. See, when you say you are assessing some data or some uh, material, what you are trying to do is you have a set of standard benchmarks. You are trying to compare this data with those standard benchmarks, trying to find out whether it compares, whether it complies with those standard benchmarks or whether there are any deviations, and then you deal with the deviations. Now, in the context of income tax, what do you mean by assessment? You are trying to assess the income or loss of a person. A person has offered his income or loss for the previous year, and assessment includes assessment of such income or loss. What does it mean? You are only trying to verify whether that income or loss is computed in accordance with applicable provisions or not. That is the concept of assessment. So assessment of income or assessment of loss necessarily implies checking of income or loss by applying the provisions of income tax, by applying the appropriate provisions of income tax. That is included in the assessment. Then it also includes assessment of tax liability. Once you assess or verify the income of a person, the next step is to compute his tax liability. So he must have offered some amount of tax as a liability. As a tax authority, you will have to assess whether he has computed his tax liability correctly or not. That is also a part of your assessment process. Once you compute the income or assess the income, once you assess his tax liability, the next step for tax authority is to find out whether any further tax is payable by such person or any tax is refundable to such person. If he has paid excess amount of tax, he will get some refund. So assessment of tax payable or refundable to such person, that is the next step of assessment. So for the income tax purpose, assessment includes 3 steps. One, assessment of income or loss of a person, assessment of tax liability of a person, and assessment of tax payable or refundable to such person. And while doing all those things, we consider the income of the previous year. We apply the law which is applicable for the corresponding assessment year. And in the light of that law, we assess the income, we assess tax liability, and we assess tax payable or refundable to such person. So this is the concept of assessment, which is not defined in the provisions, but going by the natural meaning of the word assessment and going by the expectations within the tax frame, this is the meaning of the word assessment. And then it says assessment includes reassessment. Reassessment is done under section 148. Now, sometimes there are some taxpayers who may not be honest, who may try to conceal some income, who may try to evade tax liabilities. And later on, income tax department comes to know about such evasion of tax or concealed income, etc. So what is the recourse to them? They can go to section 148 and open up the earlier assessment and do a reassessment. It will be re-verification of income, re-verification of tax liability, and re-verification of tax payable or refundable. Same process, but this is a sort of re-verification. It cannot be done in all the cases. Only in certain cases, subject to the provisions of law, one can undertake the reassessment. So the word assessment even includes a reassessment, which is done under section 148 in certain cases. If there are cases like tax evasion, concealment of income, income not getting offered for tax, frauds, or those kind of things, only in such case, such provisions are attracted or applied. Are you clear about the concept of assessment now?
Yes, sir.
Yes.
Yes, sir.
Okay. Yes. So with that, we will move on to the next definition now. Next definition is income. Is the slide clear to everyone? Slide is visible?
Yes, sir.
Yes, sir.
Uh, Now, when we discuss the income as a definition, there are almost 25-30 plus clauses. So what I have done is I have not included all those clauses on the side. I will explain what is the generic concept of income with few summaries included in these slides. And then later on, maybe we can see some examples and those kind of things. Basically, 224 defines the word income as an inclusive definition. So again, it says income includes the following. That means whatever is stated here, yes, that is income. Whatever is not stated here may be an income if by its dictionary meaning or by its natural meaning, it is within the purview of the word income. So it is a open-ended definition to that extent that it may even cover few more things which are not specifically spelled out in the definition, but which are by its natural meaning, dictionary meaning, covered within the purview of the word income. So let's begin with few key points as to what is included in the income. Profits and gains. If you are conducting any business or profession, then whatever profits or gains you make, that will be treated as your income. So income includes profits and gains of business or profession carried on by the assessee. Now, how do you compute this income? What is profit? What is gain? How do you actually calculate these profits and gains? All that we'll discuss under the head income from business or profession. So basically, those profits and gains are covered here. Secondly, income also includes dividend. If you are earning any dividend either on shares of companies or mutual units of mutual fund or cooperative societies, etc., whatever dividend income you get, that dividend income is also included within the scope of the word income. Third is voluntary contributions. Voluntary contributions are basically donations. This word is used in the context of charitable entities who receive donations which are actually voluntary contributions. There is no compulsion. People give these donations on their own. So these are known as voluntary contributions, which we commonly called as donations. So even such donations or voluntary contributions received by charitable trust are also part and parcel of income. Next is salary income. We have one chapter dealing with the income from salary. So there we will discuss in detail what is salary, what is included in salary, and so on. So basically that salary income is also treated as part of income under section 2 subsection 24. Now when you use the word salary, it also includes perquisites. Perquisites are non-monetary benefits. So from your employer, you get cash component of salary. You may get some benefits which could be monetary or non-monetary. All these benefits are part and parcel of salary, for which more discussion will follow when we discuss income from salary. But basically income includes this salary, perquisites, and all other benefits. Then income referred to in section 28. Section 28 deals with scope of business income. You have a head called as income from business or profession, profits and gains of business or profession, for which section 28 is a scope, defines the scope of business income. So there are several items which are included in section 28, which are also treated as part of income. We are going to discuss those items when we discuss income from business or profession. So when you carry on a business or profession, one is definitely your income or profit, which is considered as taxable one. Apart from that, there are few more receipts or benefits which arise from such business or profession. Those are covered under section 28 and those are also treated as part of your income. Then capital gains under section 45. When you dispose of any capital asset like land, building, jewelry, shares, mutual fund units, these are all treated as income from capital gains. And section 45 deals with scope of income under the head income from capital gains. So it tells you what exactly should be considered as capital gain under section 45. So all those items which are referred to in section 45 will be treated as part of your income. Then you have some windfall gains. Windfall gains in the sense, these are some unexpected gains, like you buy a lottery ticket and you win the prize. Or there are winnings from crossword puzzles, card games, other games, gambling, or even betting, like horse races, other types of races. Now, these are sort of windfall gains, okay? But these windfall gains are also treated as a part of your income. So even income even includes the winning from lotteries, crossword puzzles, various types of games, including card games, gambling, betting, car races, horse races, everything, all that is included. Now, when we discuss the concept of income, we have to understand the distinction between revenue receipts and capital receipts. Now, in income tax, just like accounting aspect, there is a concept of revenue receipts and taxable capital receipts. Now, income includes both revenue as well as capital receipts. If you see this section, there are few receipts which are capital receipts. For example, capital gains. It is a capital receipt. It is not a revenue receipt. Whereas your profits and gains of business or profession or some of the other items like salary, these are revenue receipts. So income includes both capital receipts as well as revenue receipts. It is not only revenue receipts which are captured within the purview of the word income. Even some of the capital receipts are also captured within the purview of the word income. Though income includes both revenue receipts and capital receipts, the basic theme of taxation is such that most of the revenue receipts are considered as taxable unless specially exempt from tax. So whenever you deal with revenue receipts, most of it will be taxable, barring those where you have specific exemption that those are not taxable. And as far as the capital receipts are concerned, the theme of taxation goes like this. Most of the capital receipts are not liable for tax except those which are specially made taxable by virtue of a provision, a particular provision made in law. So that is a concept of revenue receipts and capital receipts. Some of them will be taxable, some of them will not be taxable. That will be specified by law. But income includes both. Income includes both revenue receipts as well as capital receipts. Are you clear about the slide? Yes?
Yes, sir.
Yes, sir.
Okay. Now we come to one very important, that was the last definition actually. And now we come to the another important aspect of taxation called as basis of charge, section 4 to section 9. Just one second. The slide is clear, section 4 to 9.
Yes,
Visible?
sir.
Okay. Okay.
Yes, sir.
Now, what are these? Yeah, what are these sections called as basis of charge? Okay, basis of charge are the sections which are backbone of income tax. In a sense, if you remove these sections from statute, if you remove these sections from income tax, you will not be able to charge. You will not be able to levy the tax in respect of income of a person. So, very important sections because these sections enable the tax authorities to levy the tax in respect of income of a person. Now, what are these sections? Section 4 is a general section called a charging section or charge of income tax. Section 5 is scope of total income. It tells you what is the scope of income of a person, that is what should be included in your income and what can be excluded from your income. Those are the things which are clarified in section 5. Section 6 deals with residential status of the assessee. You must have heard of a person being either resident in India or non-resident in India. So how do you determine that? Those are the guiding principles under section 6. The only difference being similar concept is there in FEMA also, Foreign Exchange Management Act. But these are two different things. Your residential status under income tax under section 6 and your residential status under FEMA, Foreign Exchange Management Act, could be different. So for tax purpose, you have to apply the provisions of section 6. Then section 7 deals with income deemed to be received in India. It's a deeming provision. It's a fiction where you assume that certain items of income are deemed to be received in India. These are the items which we will discuss when we go to income from salary, because these are taxable or otherwise under the head income from salary. Then section 8 tells you more on the taxability of dividend. How do you tax the dividend? If it is interim dividend, what is the logic? If it is a final dividend, what is the logic? There are other types of dividend like deemed dividend under section 2 subsection 22. So what is the logic to be applied there? Those are the governing provisions of section 8. And section 9 is again a deeming provision which defines what is income deemed to accrue or arise in India. So what section 9 tells you is certain items of income are always deemed to have accrued in India. So that means we don't go by the actual place of accrual or we don't go by the actual place of receipt. Once that particular item of income is governed by section 9, then it will always be presumed to have accrued in India. That is a concept of section 9. Now section 7, 8 and 9 are not expected for detailed discussion in our syllabus. Okay, so as and when need arises, we'll be making a passing reference to those sections, but not a full-fledged detailed discussion as such on these three sections. Just to make a passing reference, have you heard of Vodafone Tax Dispute? Yes. Have you read news articles and otherwise in last few years about Vodafone Tax Dispute? Yes. Are you listening?
Yes,
Hello?
sir.
हाँ,
Yes, sir. Yes.
वोडाफोन का टैक्स डिस्प्यूट के बारे में सुना है कभी?
No, sir.
नहीं
No,
सुना है,
sir.
ठीक है. Whenever you get time, Google it out. Okay, search in Google what is Vodafone tax dispute in India. It's about section 9. वो section 9 का एक landmark issue है, Vodafone tax claim. Okay, Vodafone was fighting with government of India about certain tax transactions. Government was saying it is taxable in India. Vodafone was saying it is not taxable in India, and there was a big dispute and huge amount, crores of rupees of tax liabilities involved. Okay, so you can search in Google what are those kind of articles. Make a passing reference, of course. That's a major thing. So income accrued or arise in India is actually a cause of major litigations also in the past, because it's a very powerful section to consider some of the items as deemed to have accrued in India. Okay, so this is the introduction of 4 to 9. Now we will begin with section 4. Section 4 is basically charge of income tax. What section 4 says? The charge of tax or charge of income tax is in respect of every person. That means every person is subject to levy of tax. The charge of income tax is to be levied on every person. Nobody can escape, every person. Now, when you levy the charge of tax on you on every person, on which income you will levy the tax, that is clarified in the provision. It says that in respect of income earned in the previous year. So what we are looking at is income earned by such person in the relevant previous year. Okay, so we are restricting ourselves this point at this point in time to the income of the previous year. Now, how will you compute the income? Because you have to levy the tax. So how will you compute the income? It says that computed in accordance with provisions and tax rates applicable for the given assessment year. So while computing income, what are we supposed to do? You have to go back to the assessment year. Find out what the provisions of assessment year. Apply those provisions and then compute the taxable income of such person. Once you apply those provisions, once you get taxable income, then you apply the tax rate. Again, which tax rate? Which applies to the relevant assessment year. And once you apply the tax rate, you will get the tax liability of such person for the given assessment year. So section 4 is a very important enabling provision which enables the tax authorities to levy the charge of tax on every person. Which income is captured here? Income that belonged to the previous year, income which was earned in the previous year. How do you compute the income? By applying the provisions of governing assessment year, by applying the provisions of corresponding assessment year. And how do you compute the tax liability of the person? Apply the tax rates which are specified for the concerned assessment year. So these are the basic provisions of section 4 that deal with levy of tax in respect of income of every person. So every person is subject to section 4, and based on that, income tax authorities can levy tax in respect of income of such a person. Are you clear about provisions of section 4? Yes?
Yes, sir. Yes.
Okay.
Yes, sir.
Okay. Yes, fine. Now we have two more sections for detailed discussion. 7, 8, 9, as I told you, passing reference as and when required. Two more sections are section 5 and 6. Out of this, we will first discuss section 6 and then we will go back to section 5. Section 5 will be the last thing to be discussed. Okay. So let's move on to the section 6 that will deals with the residential status of the assessee. Now section 6 tells you how to determine whether a particular person is resident in India or not a resident in India. Those are the basic provisions of section 6. But section 6 has different categories of provisions which will apply to different types of persons. So before we go that, let's understand what is resident in India and what is not a resident in India. Section 2 subsection 42 gives you definition of the word person resident in India, and what it says is simply that if you fulfill the applicable provisions of section 6, then you are resident in India. So what is a resident in India? It's simply a person who qualifies as a resident by satisfying the applicable provisions of section 6. That person will be called as resident in India. And who is a non-resident? You have section 230, which says that non-resident is a person who does not fulfill the provisions of section 6 which are applicable to him. So in other words, in order to be resident in India, you have to fulfill the conditions of section 6, whatever is applicable to you. If you don't fulfill the condition, you will become a non-resident person. Very clear concept of resident and non-resident person. Now, couple of questions. First, whether this is same as status under FEMA, Foreign Exchange Management Act, which also has a concept of non-resident person. And the answer is no. FEMA has a different set of provisions. So those will be separate provisions. And for income tax, you have to separately assess the residential status of a person by applying the provisions of section 6. So these are two different provisions. We are going to deal with provisions of section 6 and not FEMA. Number one. Secondly, once you say that a person is resident or a non-resident, will it be his lifetime categorization? And the answer is no. Once you get a stamp of resident or non-resident, it is not a lifetime kind of a stamp. It will change from year to year. So for every assessment year, you have to apply the provisions afresh and find out whether the person is resident or non-resident. It is possible that for a particular year the person is resident. It is possible for the next year that he may become a non-resident person, because these are based on fulfillment of certain conditions, and if you fulfill in one year you will be resident, if you don't fulfill in another year you may be non-resident. So the permanent status as such is not conferred under section 6. The changing scenario may change your status, so person may become resident, non-resident depending on conditions prevailing in the relevant previous year. It is not a static kind of a phenomena. It is not a permanent stamp on a person that he is resident or non-resident. It may keep on changing year after year. Are you clear about concept, resident, non-resident, and these couple of important points?
Yes, sir.
Yes. Okay.
Yes,
So
sir.
now,
Yes, sir.
yeah. So now we are looking at different cases or different subsections where the governing provisions are given. For example, 6.1 and 6.6a. These are the two sections which determine the residential status of an individual. So if you are referring to an individual, what you should do, you look for provisions given in section 6.1 and section 6.6a. Suppose you want to determine the residential status of Hindu undivided family. The appropriate section will be section 6, subsection 2. If you want to fix up the status of a company, then the relevant provisions are contained in section 6, subsection 3. If you are referring to the status of firm, association of persons, etc., then the applicable section is section 4. And then section 5 is a very general provision which says that if for a particular source of income your status is resident in India, then for all other sources of income also the status will continue to be that of resident in India. That means you cannot have a different status for different types of income, for different sources of income. For one source of income, if your status is resident, then all other sources of income also your status will continue to be that of resident in India. So these are different sets of provisions. Now our syllabus also covers these provisions, and we also have computational sums on this, whether a person is resident, non-resident, etc. But that is limited to only individual. Okay. So HUF, company, firm, we are not going to determine the status. We'll understand the provisions, no doubt, but we will not determine the status or work on practical sums on that. We'll be working on the practical sums of sections 6.1 and 6.6a, which are related to residential status of the individual. Now, when you think of 6.1 and 6.6a, basically for an individual, it all depends on period of stay in India, how long a person has stayed in India. That's how the residential status of an individual is established. So section 6.1 tells you some conditions which are based on number of days which you have spent in India. If you have spent X number of days in India, then you become resident, non-resident, whatever. Those kind of provisions exist in 6.1. 6.6a gives you one more category of resident individual, and that also we will see what are the provisions of 6.6a. Whereas for remaining categories of assessees like HUF, company, firm, etc., there is no concept of number of days or how long you have been staying in India, etc. There the parameters are completely different. There we don't follow those kind of parameters. There the parameters are different. So with this, I think we will conclude today, because once we get into 6.1 and 6.6a, that itself will take about half an hour to conclude, and then remaining provisions. So no point in doing it halfway through or rushing it through in the remaining time. Okay. So today's discussion, of course, I'll wind up here. But if you have any other queries or something, we can discuss in last 5 minutes which we have. Okay. Or even today's session or earlier discussion, if you have any queries, we can keep time for that. But at least this discussion, I will wind up now. Okay. So do let me know if you have anything else which you have in mind, any queries or whatever about whatever we